Here to share his insight on the geopolitical tensions, the impact of what you should do is Kyle Bass. He is now co-CEO at Rochefort. It is a new U.S.-based national security-focused firm that invests in defense and industrial companies. I can personally tell you, Kyle, very, very well connected and dialed in on all things international and national security, even as a new picture. Kyle, so we're glad that you're on. Thanks very much for joining us. I have to admit, I'm optimistic about how this all ends. I want to be, but because I'm never going to bet against the U.S. or the U.S. military. But I am a little surprised that the market seems to be like a honey badger, just doesn't give a you know what. Are you?
Yeah, I mean, look, Brian, it's important to realize that the impacts of the Straits closure are going to be bespoke. They're actually going to be they're going to be adjudicating a long policy prescription for some countries around the world that have just tied a green noose around their neck and just choked themselves with it. When you think about the countries of Europe, the UK, even Australia and others, they've just decided that refining is a dirty business, that they just need to push it out to places like Singapore and Malaysia. And these countries have engaged in huge renewables pushes. And in the end, they've been doubling down on these renewables pushes. And what you see happening now is they are going to pay the price. The U.S. economy is not going to pay the price that the UK economy is going to pay, or that the French economy is going to pay, or Australia for that matter, and the others. We are the global powerhouse in both hydrocarbons and food and AI and technology. We literally have the benefit of being the best at all of those things these days. And the countries that have kind of pushed off those dirty businesses because they really wanted to pursue green policies, those are the countries that are going to be paying $250 a barrel or more for their refined products like diesel and jet fuel and things like that, Brian. So again, this is not going to be felt evenly around the world.
Kyle, it's Kelly. If I could just jump in here for a second, what I appreciate is you're not just talking about this as a kind of geopolitical analyst, although we love them as well, but you are investing in industrial and defense companies. What kinds of companies are you investing in? Are there any public companies our audience might be familiar with, or ways to think about, the characteristics that you think make for an attractive investment in those areas right now? Sure.
It's a great question, Kelly. I think our defense budget today is about $1 trillion on about a $31 trillion economy. Call it a little more than 3% of GDP. If you look back through history, throughout the Cold War, we were 5.5% to 6% of GDP. Going all the way back to Vietnam, we're around 11% of GDP. And in World War II, we actually spent 47% of GDP, 1945, because we had to win. And one could argue that 3% is not enough. And you see President Trump already saying he wants to have $1.5 trillion budget next year, a 50% increase, which would get us to like 4.5% of GDP. And so when you think about those tailwinds, not only in the U.S., Europe's finally trying to get out of their own way and finding a defense investment because the U.S. has been providing that nuclear umbrella to Europe all along, and they haven't been towing their weight with their NATO pledges. So Europe's going to have to actually step up and start funding their own defense. We are going to invest heavily in our own munition stockpiles, our own attritable, call it smaller, easier, let's say, less expensive weapons. And that is going to be where the U.S. economy is going to be driving defense spending for the next decade or so. And so, Kelly, what we're doing is helping those small companies, the U.S. best and brightest, grow their balance sheets and be able to take orders from the U.S. government and our allies.